Hello, chart watchers, and welcome to this Monday, February 12th Market Watchers live show with your hosts, Tom Boley and Aaron Swinlin. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, we got the market actually looking up this morning. You can see here that the Dow Jones Industrial Average, after gapping up, pulled back close to the open, and now we are back near the highs of the day on both the Dow Jones, which is up 341 points, and the S&P 500 up over 31 points. The NASDAQ nearly up 100 points now at the high of the day, and the Russell 2000, which had lagged early, now moving back into positive territory. 10-year Treasury yield gapped up to 2.88% at the open, pulled back, filled the gap, and now back on the move at 2.86%. Volatility declines off of the high that we saw on Friday afternoon up near 40, back down into the 20s. Still elevated, but down quite a bit from what we saw at the end of last week. Technology leading the market advance today. You can see up over $1 on the XLK today. Computer hardware doing extremely well, led by Apple. Apple up over $5 today. Certainly great news there for Apple shareholders. Energy stocks trying to rebound also, with crude oil hitting a very important $59 level on Friday and bouncing today. So we've got, you can see the energy group doing well. The exploration and production index among the leading areas of energy. And there you can see oil rebounding. This is the ETN, total return ETN. But this is up, you can see, over 1%, close to 1.25%. So we're getting a rebound there as well. With the 10-year Treasury yield rising, utilities lagging the market. But otherwise, we are seeing mostly up action to start the week. And so with that, Aaron, how was your weekend? And what do you think of this action so far?
Oh, had a great weekend. And yeah, I'm really interested to see how all of this plays out this week as far as the markets go.
Yeah, it's going to be really interesting, especially with that volatility index still up. I mean, it's always nice to get those rebounds. I like to see strength into the close, but we saw that, I think, last Monday. And then the market, had one day where it just kind of floundered a little bit, and then right back down we went. And we do still have the volatility index up there, as I was showing. We are currently with the VIX up, at an elevated level, 27.5 roughly, or 27. But anytime you get up into the 20s and certainly the 30s and the 40s, we just see these rush, periods where we have a rush for the exit, and not too many folks are buying at support. It gets a little unnerving for sure. A lot of stops being triggered here over the last week or two, and so I don't know. What I'd like to see is the VIX kind of settle back down below 20. Arthur Hill was on with us last week, and he pointed out he watches that 20 level on the VIX, and so still with it up at 26 and change right now, it's a little bit unnerving.
Absolutely. I know I recommend everybody go read Carl's weekly wrap in the DecisionPoint blog, because he did discuss the possibilities of how this could play out in terms of being a bear market. So.
Oh, okay. So for those bears that are out there, and there's a lot more bears now than there were 2 weeks ago, I can promise you that.
Mm-hmm.
No doubt about it. But anyhow, we got another packed schedule, so I'm going to let you go through the announcements and the agenda, and we'll get started.
Absolutely. Let's go for it. So for the weekly schedule this week, I know we've got, let's see, tomorrow is Everything Stock Charts. I'm not sure who's coming in just yet. Charles Kirkpatrick, author of Technical Analysis, the book, and Julius de Kempener is going to be back to talk RRG with us on Thursday. And finally, I don't think we have it on there, but I will be doing a workshop on Friday. Still working out what I'm going to talk about, though. So yes, suggestions are always welcome in the survey after the show. Give me some ideas. But for today, We're going to start off with our Monday setups. Few and far between. I don't know about you, Tom, but it's been a little difficult. We have an earnings spotlight. John Hopkins will be in with us to discuss a couple of stock symbols there. And of course, 10 and 10 to 1. And our very first symbol is going to be 3M Company, MMM. And finally, we'll finish up. I'll give you the DecisionPoint report and let you know what I'm thinking about the market and our indicators. So, and from there, I think we should just get this kicked off, Tom.
Jump right in. All right, let's see what we got for today. Well, there were no economic reports out this morning, but I still always like to start with 10-year Treasury yield, see what's going on in the bond market. And you can see that the uptrend in the yield continues. A lot of folks are blaming this sell-off in equities on rising interest rates. I'm not quite so sure I'm going to buy that argument. I think that, again, it depends on why interest rates are going up, but if it's because of a strengthening economy, that normally does not coincide with a top in the market, in the equity market. So we will have to wait and see. But nonetheless, you do see a nice movement to the upside in the TNX. I think 3%. Not only is it a big round number, but it's also where the last attempt at a rise in interest rates failed on the 10-year Treasury yield. So I think that 3% level is certainly going to be worth watching. Apple up $5 or up over $5, as I mentioned earlier. You can see here it is up $5.50 right now, and pretty close to the high that we've seen over the last week or so. Off of all the selling, the reaction high on Apple has been coming in right at about 162 to 163, and we are at 161.93. I think this obviously is a big leader. A lot of folks looking to Apple to see what happens here. I find it interesting that on this pullback that we saw, we got almost all the way back down to the 150 level, that it is very good support. And I think if we pull up a weekly chart here on Apple, you'll get an idea. Looking at this weekly chart, notice that the highs that we put in August, and then again the highs that we put in at the end of 2017 and early 2018, all of these highs were coming with lower weekly PPO readings. So we had negative divergences. We were able to hold on to the rising 20-week for a while, but with all the selling that we saw last week and that huge surge in the volatility index, Apple, like so many other stocks, didn't really care about the price support that was down just below 170. It didn't care about that 20-week moving average, which was at about 168. Didn't care about the most recent high, which should have provided support up around the 163, 164 area, and we just kept going down. The good news is, though, that we did get a 50-week test, and you can see now for the first time in almost a year, we've got Apple, instead of having a particularly high PPO, as a result of all this movement to the upside, we've seen a lot of more consolidation, and as a result, we're getting that weekly PPO back close to the center line, which I find to be somewhat bullish. I want to see this consolidation. I want to see things unwind, and we are seeing that with one of the tech giants in Apple. The other thing I wanted to point out here, and I think I'll stick with this weekly chart, let's take a look at the WTIC, which is the price of crude oil, and notice that on this weekly chart, crude oil had been on a roll since about June or July of last year, continuing to move higher. Here is your PPO, the weekly PPO, continuing to move higher. So what we normally look for is a pullback to the rising 20-week moving average, which was at 58.53. That's where it is right now, and you can see the close on Friday went down to 59.20. But the good news is when we pull up the OIL, let's do this on a daily chart. When you pull up the OIL, you can see that we are up a little bit more than 1% today on the price of crude oil. So that is a good thing to at least get us started. Now, we did have a comment that came in last week, and it was more of a bearish comment. It came through our survey responses, and we do read them all. And this particular comment said essentially that we're always on the bullish side of things, kind of like, we have rose-colored glasses on, and, we're not paying attention to what's going on with this downtrend and so forth. And I'm putting it a lot nicer. I'm not going to.
That's true.
I'm not going to mention any names, and there weren't any names given anyway. But I mean, it's a fair comment. The market got hit pretty hard last week, and I certainly didn't see it coming. I mean, we've talked about a pullback that we've been expecting for many, many weeks. But trying to tell the market that it needs to pull back is not an easy thing to do. So what I thought I would do is try to explain a little bit of the mindset behind where I am in the market and why I remain bullish. First of all, I don't go from bullish to bearish because of a couple of trading days. That doesn't happen. I mean, the market is a puzzle, and it takes a lot of action. It takes a lot of things happening to turn a bull market into a bear market. So I'm going to show you a few charts, and hopefully this will make it a little bit clearer of, kind of what I'm looking for. Now, if you look at the S&P 500, and I go back the last 12 years, so that takes us all the way back before the prior bear market, and then this uptrend that we have now been in. We've been in a beautiful channel here since 2010, where you can see the highs you can connect, and also these lows you can connect, and it's just a beautiful channel. Now, we were getting up close to the upper end of this channel with the high up near 2,900 on the S&P 500, and we've pulled back. Now, if you look at just the last 2 weeks on a daily chart, it'd be very easy to grow extremely bearish and panicked. But I think if you step back and you look at a chart like this, it just shows you, I mean, we've had a number of pretty bearish periods, but we've remained in this uptrend. So I think this is the first key. Number one, we still have a channel in play that's been in play now for 8 years, and we haven't broken down out of it, and we're going to pull back from time to time. I think everybody 2 weeks ago would have said, we need a pullback. So now that we've gotten one, it's not just the fact that prices have come back, but what is happening underneath the surface. I'm going to get into some more of that in a minute, but one thing I wanted to talk about was the S&P 500 relative to the Russell 2000, which is a small cap index. One factor that goes into all of this in terms of what area of the market's going to outperform or underperform, one component, one piece of this is the dollar and which way the dollar is heading. Because your S&P 500 is made up of a lot of multinational companies that do a lot of business overseas. And if there's a weak dollar here in the U.S., then all those foreign profits are being translated over using a cheaper dollar, and the EPS grows as a result. So usually what will happen is when you're seeing a weak dollar, you see the S&P 500 outperform the smaller cap Russell 2000, where most of the companies in that index do almost all of their business domestically. So they don't benefit from these foreign currency translations. And so the dollar is not going to impact those smaller companies like it will the large multinational companies. So what I did is I just went back over the past, let's see, this goes back 10 years or so, maybe 11, 12 years. This was a 12-year chart. So, and what I've done is I've highlighted some of the periods where the dollar has made big moves to the upside. And when that happens, when the dollar is rising, it tends, this is the ratio of the S&P 500 to the Russell 2000. It doesn't tell you that the S&P is going down in each of these instances. It's just telling you that it's underperforming the Russell 2000. So keep that in mind. So here's the dollar rising. I picked 4 periods where it's had its biggest impacts to the upside. And during each one of those cases, you can see that the S&P 500 has been downtrending on a relative basis. Now, if you look back over the last 14 or 15 months, the dollar has been moving lower, and as a result, we've been seeing the S&P 500 outperform the Russell 2000. But I do want to point out that we haven't seen a breakout here, even though the dollar continues to hit lower levels. We're not seeing a breakout in the S&P relative to the Russell 2000. That makes me wonder, because we are now at, or we just recently hit, a pretty key area, I think, in the dollar index. After losing support around 93, we went down to 91 and change. We bounced one time. I know Greg Schnell, I think there were a couple others. I think maybe Martin Pring was talking about that bounce, and Aaron, you may have said the same thing, looking for a short-term bounce. And now we've got the dollar moving all the way back down, breaking to new lows. But I do think this is an area that needs to be watched. We had a multiple top back in 2008 and 2009, 2010, right at about $88. And you can see after the breakout, we haven't gone back down below that level. So that should be an interesting area of support. And then also, if you connect the trend line or these lows and form a trend line, it comes in right at about 88 as well. So the reason I bring all this up is if the dollar does bounce from here, keep in mind what typically happens when the dollar starts to move higher. It normally means more money rotates towards smaller stocks and away from the S&P 500. So that was the comment I had there. Now, When you look at the dollar now, actually, let me go back to this chart one more time, because when you're looking at this, the dollar index, it's not showing. This is the USD, which only reports on the close. So it's not showing what's happening today. What's happening today is the dollar actually is back down again. So if we go to the next chart, the UUP, this is where you can see today's action. So the UUP is back down a little bit, but we have bounced nicely in February. And now the question becomes, do we hold that rising 20-day moving average? I'm not sure. It'd be interesting to see. All right, this is a chart. This is why I remain bullish. This is why I believe the market is we should still be playing by bull market rules. This is going back the last 3 years, the S&P 500 rising. Here's technology versus the S&P 500 rising. Industrials versus the S&P 500 rising. The consumer discretionary has just absolutely exploded to the upside, breaking out and rising on a relative basis. Financials continuing to rise on a relative basis. The XLY versus the XLP. So if we're looking at just consumer stocks, we want to see money rotating to the aggressive areas. It's rising. Transports versus utilities recently broke out, pulled back a little bit so far here in 2018, but still, in my opinion, is on the rise. Banks, which do better in a strengthening economy than the REITs. REITs are very interest sensitive and tend to move lower when rates are on the rise. You can see banks outperforming REITs. And then finally, the 10-year Treasury yields rising, meaning money is coming out of the bond market. So I don't see anything on here that suggests to me that the market is positioning for something nasty down the road. And if you want to take a look back, and let's go down memory lane, one more chart. This is the, it's the Dow Jones, but technically, really, it should be the, I meant for it to be the S&P. Let's change this. Although I'm going to lose my annotations. Let's just keep it the Dow, but instead of the S&P 500. But I think you're still going to be able to see exactly what's going on. Now all of the ratios are based against the Dow instead of the S&P. But look back to 2007. This is 2005, middle of 2005, over to 2008. And so here was our bull market. Here's our major index, the Dow rising. And you look at the XLK, and it's kind of doing okay when we started in February, March. Actually, let's look at February of 2007. So this is about 8 months before the top. And you can see that, as we look at these same ratios, they're all doing okay. Not great, but okay. You can see the banks had started to decline. Of course, that was right before one of the worst financial disasters in our history. 10-year Treasury yield started to decline a little bit. But look at what happened by the time October had rolled around. So we kept trying to go higher and higher in our major indices. Technology was still okay. Industrial's okay. But look at the consumer discretionary space, completely falling apart. Financials already completely falling apart on a relative basis. Discretionary versus staples beginning to fall apart, but you can see in the latter part of 2007 really completely fell apart, losing multi-year support. Transports versus utilities also on the decline. Banks relative to the REITs after a little bit of an increase have fell apart again toward the top. And here's your 10-year Treasury yield starting to fall down, meaning that money is now rotating into the bond market. So when I look at these two charts, they're like on opposite ends of the spectrum. It's hard for me to get bearish when I see the current setup so much different than we saw back in 2007. And I know that everybody's got their own opinions, and certainly every bear market can start differently. There's no guarantee that this one's going to start the same way 2007 started. But I would expect to see rotation into more defensive areas, and we are seeing literally none of that right now. So with that, I'm going to turn it back over to Aaron. I know you've got some upgrades and downgrades. What do we got for it today?
Okay, we do have, yes, 3 upgrades, although we were discussing before the program, there's about 14 out there. We picked 3 to go over, so let me go ahead and I will switch my screen. And the first one I'm going to look at is Cisco Systems, C-I-S-C-O, Cisco. And again, these are upgrades. So I've got 3 upgrades for you. So I was looking at this one, and I do like, we had a little bit of craziness going on here, but it did hold this area of support, starting to come back out of it. If I do a solid line here, I think we might have a double bottom forming. So let's go ahead and just see what that looks like. Indeed. Double bottom, and we've now executed that double bottom with that break above that neckline. So I would be looking for a move about the size of this pattern, which would bring us up to, well, very close to this area of overhead resistance. So that's what I would be looking for there. So nice upgrade for Cisco. The other one I have is VFC. This is VF Corp. And another double bottom is formed here. And you can see the execution of it, and that would definitely bring you right up there to overhead resistance. PMO is now ticking up with today's almost 3% move to the upside on this upgrade. But I think this one still looks pretty good. And obviously with the upgrade, it's showing some strength. Schlumberger, really quite interesting. I'm going to put this back on a OHLC bars, which I like to use. If I can get my mouse to cooperate. Here we go. We're getting ready to hit some really important, it looks like we've found some support here. I would be a little concerned that we could end up coming back down and testing some of these lows. And I say that because the PMO is still on its sell signal, and we're really not seeing any type of deceleration. OBV is still trending lower with price, which to me says that, you know, we're looking at a bearish confirmation. So this did get an upgrade. So I would be keeping this on a watch list just because it has been upgraded. And we could see this as a good bottom that matches up right here with these tops that we saw in December. So I think this one has some possible potential, but I don't think it's there just yet. I would still be a little concerned about coming back down and testing these lows down here at about 62 or 60. We had 3 downgrades that I'm going to look at. SMI is the first one, semiconductor manufacturing. The first thing that presented itself to me when I looked at this chart was this double top and the now execution of it that we had last week. The PMO is still declining. We are hitting some oversold territory for the PMO, which is a good thing, but that gap down to me, we could be looking in an island and a move back up because this is an area that you could make a case for being support. I don't like it though, because I'm not seeing enough positive momentum at this point. I'm not so certain we're looking at a reverse island. I think we're looking more at a double top, and that's a very large pattern, and that's going to bring you past this area of support in August. So I'd be a little bit concerned about this one. I don't know if I'd be trying to bottom feed on that particular stock. Another downgrade for us, La Jolla Pharmaceuticals. And, I was looking at this one earlier, and you can see we're coming down to this support area at about 32, which has been a decent area of support. But notice the PMO. It's topped and is now getting ready to head lower. The scooters is starting to fall off. OBV doesn't look that ugly just yet, but I wouldn't, this isn't one I'd be bottom feeding off of. All right, last downgrade that we have. This one I think looks very interesting in that this area at $24 is a pretty strong area of support. We're coming back down to test it a second time. Yes, the PMO did top below its signal line, but it isn't getting into oversold territory. I'd be watching that $24 area. If it can hold that over the next day or two, I think you've got some pretty nice upside potential. But there are some things to still be a little bit concerned about as far as, the setup of the EMAs. The 50s getting ready to cross below the 200, and that's a long-term sell signal. So with that pretty much completes the upgrades and downgrades. I'm thinking I might just go ahead and get us right into, let's go ahead and get into some Monday setups. But I need to share the proper screen. Alrighty, come on now. Help me out. There we go. Resume share, but I want to share something different.
You want me to take it?
Yeah, why don't you go ahead and then I can try and get this organized.
All right, we'll jump into the Monday setups. And first, I know, Aaron, you had CIT. So let me.
Oh, yes. We have to look at the damage done last week.
Yep, I know. I got my tail tucked between my legs right now because this was not a good week for VRTX. But if nothing else, it definitely emphasizes why, especially with a volatility index up in the 30s and 40s, you want to make sure you keep your stops in play. CIT was Aaron's pick, and I don't have the numbers but it was 5 days ago, so I'm guessing it was probably around 51 and change.
Yeah, 51.44.
44. Okay, so actually this one held up, I think, pretty well, and it is in the financial space. It's a specialty finance company, and financials with the 10-year Treasury yield rising, I think actually outperformed most of the areas of the market. So certainly a good week to be in a financial stock. But CIT, so you were down maybe 1.5% or 1%, a little over 1%, whatever. I would actually call that a winner, to be quite honest, based on last week.
Well, thank you.
I think it held up pretty well. And, looking back at the chart, I think actually it's held the prior lows. You can see multiple tails coming in, maybe in the 48.5 to 49 area. And you can see the low back early part of last week got down to 49. So right in that support zone, it bounced off of it, continuing to hold. And got a little bit of a downtrend here that it's been on. But I would suspect that if we continue to see higher Treasury yields, I would expect financials to do well, and I would look for CIT to make that break. But we'll see in time. Now, my pick, on the other hand, and this is where I probably should just leave the show, was Vertex Pharmaceuticals. I really liked the biotechs, and shocking today, actually, the stock's down, but I think the biotechs were doing pretty well. So this is a poster chart. Yeah, the biotechs are bouncing back. So this is a poster child, I would say, on why you want to keep your stops in play, especially with a volatile market. I think Vertex was like 160 last week. It was coming down below the 20, hitting some key areas of support, but you can see they didn't hold. We've continued to trade well below that 20-day moving average, which has rolled over now, trending lower. And so the stock is down about $9, which is, I don't know, maybe 5.5%. So that's two consecutive pretty nasty picks for me on the Monday setups. And of course, we're in a pretty nasty market right now, but looking at it, it's hard for me to make an argument. I like the biotechs, but I actually like some of the others that have held price support better than DRTX. So I'm gonna pass on this one, I think, and I'd have to wait for some more strength at some point before I would be interested. So I will go ahead and give you my setups for this week. And I'm going to start, and this one's up today, and I always shy away when I have a stock and it's bouncing, but I'm going to stick with it. So the first one I'm going to go with, and let's get the most recent reading, is Varian Medical. This is going to be my pick for this week. I liked it obviously better on Friday's close because we were down at gap support. It's up to 2% today, but the current price is 116.73. So I'm going to go with Varian at 116.73 as my pick for this week. But I do have some other stocks that I put in setups. I ended up not putting any setups in last week. That's the first time since I've been doing my blog and been doing these Monday setups that I just refused to put anything out there. The market was so volatile, I thought that there was still a lot of room potentially to the downside. I think the ones that I have in here today have fairly solid, established support levels. And again, if the VIX picks up, goes back up to 40, you want to make sure you keep your stops in play. But I think Varian looks pretty interesting because it has returned all the way back to where it was when it reported excellent quarterly earnings, and that's what triggered this big move to the upside. The second one is Costco, and I know these charts probably look a little smaller on your screen, so I'll just point them out to you. But Costco wholesale, COST, I think that between the top and bottom of gap support here, and also there was a lot of sideways trading between 177.5 and 180 back in May and June. I think this creates some pretty decent support for the stock. That's where we were bouncing last week. So I would look for Costco to hang in at this level. PRGS, Progress Software, another one, had great earnings, a really strong bullish response to those earnings, but then kind of got caught up in this downdraft, especially with some of the small caps and so forth. But Progress Software now is back. It's hit the 50-day moving average, I think, in what I would call like an accumulation zone between 44 and 47, 47.5. and coming off of a high near 53.54. I think that one sets up pretty nicely. Also, the RSIs had dipped down into the 40s, and going back, you can see anytime the RSI during this uptrend has gone back into the 40s, that has typically been a pretty good entry point into Progress Software. PNC Financial, again, one of the financials. This one held up really well, as well as many of the financials last week because of the rising treasury yields. But PNC, I think, continues to look strong. And the lows that were put in last week, I think, would present great opportunities on any pullback. Right now, it's in the middle of a zone of a trading range between about 146 and 160. And we're sitting at 152.70. So I don't know that it's much of a trade here. But if the market sells off again or the financials start taking a hit, anything back down below 150, 149 starts looking interesting, I think, on PNC. And two more, PTC. This is a company that also reported great results, gapped up, took out a triple top and gap support here down at about 56.5. With all the weakness last week, we came all the way back down and filled here. I think the combination of that gap support and the 50-day moving average could be strong support for PTC. And then finally, McCormick and Company, MKC. I had mentioned this one, I think, on the program maybe a week or two ago when we had this ascending triangle that had been building. We broke out. We went back down and went a little bit below the breakout level, but notice we bounced off that rising 20-week moving average. I think this one could move from here. It's a little bit more defensive, so it's not going to be as crazy in terms of the price swings as many other stocks. So if you're a little more risk averse, MKC might fit your trading style a little bit better. And with that, I will turn it back over to Aaron. What do you got for this week?
All righty. I have about 5. I wasn't overly thrilled with any of them. I'll just be honest with that because, we've had this pullback. I think there's some opportunity lying out there. But it's not my preference to start trading into a market like this. It's still a little uncertain for me, and so I prefer not to. So I'm sitting mostly in cash as far as my cash accounts are concerned. I still have my buy and holds. Anyway, the first one I'm going to look at here is Lumber Liquidators, and I thought this one was interesting because wait, that's the wrong one. That was what we were looking at earlier. Let me go to the right one. Here we go. All right, so that was my pick last Monday, and here we go with, actually, I think this is actually going to be my pick this week, Coty, C-O-T-Y. It's currently, I guess, at 2012, so not bad. We've come up here. We had this nice gap, and to me, I was looking at the gap as maybe a breakaway gap, just the beginning of a nice move, a nice pop. And we can see that the PMO was yanked, obviously, upward with that gap. I would expect to see maybe a pullback down to that $19 level to test it. But, we broke up above that $20 level. So I'm liking this one. The scooter is improved. I like the accumulation thing going on here with that gap up. I think that looks pretty good. So we're holding that $20 area support. And I think you've got some upside potential all the way up to $21. So I do like that. I think if I were to get in, I would probably set my stop, around 1975 if I wanted to be more conservative. 1950, somewhere in there would be where I'd want to set a stop. But I think definitely my upside target be right about $21. The other one I have for us is MC, not MKC, but MC. I thought this one was interesting. These came up on my scan, and you can find that scan. The link is at the bottom of every Market Watchers Live blog article, and as well as every DecisionPoint article that I write. You'll find the link to my scan at the bottom there. So this one I thought was interesting, but we hit the overhead resistance and we're heading back. So even though I like the way this PMO is, I was looking at it and, you could make a case here for a negative divergence. So this wasn't my pick, but I think it's still pretty interesting if we get that breakout. And let's see, Tilly's is back on my list. Actually, full disclosure, I still own it. And we got the breakout above the neckline on this double bottom. It looks like we've just about hit the minimum upside target, which is right around $15. But I really like the fact I just got this PMO buy signal. on that breakout above that neckline. I think 1550 is a realistic upside target, which is what I'm shooting for. And then I'll reevaluate once I reach that target. But I have every expectation to make it. Let's see. Virtusa Corp was the other one. I see this flag formation in the thumbnail. I think that is good. Of course, you can see the PMO is turned up in near-term oversold territory. Need to get the breakout, which is why I didn't pick it, because as a Monday setup, I think when you look at this, we might end up pulling back just a bit more to build this flag a little more before we get the breakout to the upside. So I didn't want to wait for that on a Monday setup because we only get a week. So I want to make sure I can get some movement in a week. All right, this one, I know it's already had this amazing breakout today. It didn't hit my radar until this morning, unfortunately, but I still think it's lined up very nicely. I did not pick it because I would expect to see a bit of a pullback here. That's just such a huge move. I don't know. They reported earnings or something. I'm sure you guys will let me know. But I thought this one was interesting. Might be good on a watch list. Watch for a pullback here. Even to like that $26.50, $26 range. And then I could see it continuing up and going to the races. So looking at that weekly chart, look at that, $28. We should be able to get to $28. But I think we need a pullback first. So those were my Monday setups.
Okay, so I guess to recap, you have Coty, COTY, and I jotted down $20.12. And I have VAR at 116.73. That should be, and there you go. And then, of course, you can see the other stocks that we had spoken about as well. So I don't know. We'll see whether or not the market, I think it certainly would help if we could get the market to settle down a little bit and see that VIX continue to drop. Like Arthur, I'd like to see it back down below the 20 level, but, you know, we get a little selling and you see it start shooting back up in the mid to upper 30s, then make sure you have your stops in play for sure.
Yeah, I would say at this point with the market the way it is, I would be watching my stops very, very closely.
No doubt about it. All right, and with that, we will swing over to Earnings Spotlight. This Earnings Spotlight is brought to you by EarningsBeats.com. EarningsBeats.com is a trading service designed to provide high reward to low-risk trades. The strategy resulted in a 2017 risk-adjusted return that outperformed the benchmark S&P 500 fivefold. EarningsBeats.com only trades companies that have beaten Wall Street estimates as to quarterly revenues and earnings, and they will teach you to focus on that combination of strong fundamentals and strong technicals. Learn to exercise the patience and discipline of an experienced trading service. EarningsBeats.com, better timing, better trades. Mr. Hopkins, how was your weekend?
Not bad. How about you?
You know, it wasn't too bad. It's warmed up, you know, so
yes.
You're in South Carolina too. You're over on the good side of South Carolina with the water.
I'm actually in Maryland right now.
Oh, I don't know where you are then.
But it's definitely, you know, warmed up. No question about it. Unlike the market's warmed up a bit, you know, today. But, you know, Tom, to me, I give you and Aaron some bravery points, you know, for giving some potential setups, because right now, I don't know, I feel like we're in a bit of no man's land. Market got extremely overbought, as we saw. Then on the selling, it got oversold, at least, you know, last week it did. And now, you know, we're getting a nice oversold bounce. But to me, it's very tricky, you know, to propose setups here. And the reason is, you know, when the market's really bullish, Tom, and you've got momentum going, you're above all key technical levels on the major indexes, you have a bit of confidence when you're doing trading. When all of a sudden all the major indexes are below key technical levels, the VIX is in the mid 20s to 30. It's what I call a two fingers in the sell button. There was a point where the VIX had risen off the bottom, and I think maybe gotten to 14, 15. I called it a one finger in the button sell possibility. Now I think people have two fingers in the sell button. So if all of a sudden they see any weakness in the market, they get a little bit finger happy, and put in those, put in those sell orders. So the reward to risk to me, even though it's great that we pulled back, and one could say the reward to risk is much better now, I'm still a little bit leery here.
Well, I think the thing is when you get high volatility, you get these big swings. So it's really hard to manage risk. And that's what I've said all before. And I'll keep saying, I don't like trading a market where the volatility index is in the 20s, 30s, and 40s.
No.
It definitely creates some great opportunities to make money to the upside, but that comes with substantial risk to the downside. And we saw that risk on 2 or 3 occasions last week when, to be honest, no support levels really mattered. It didn't matter where price support was, where the moving averages were. When you get a volatility index up in the 30s and 40s, it's just like hot knife going through butter to the downside. I mean, the selling just continues without a pause.
Yeah.
And my interpretation of that, what I always say is market makers go on vacation when they see the demand, or excuse me, supply is completely outstripping demand. Would you want to put your money up and try and stabilize the market when you're getting ready to get by a stampede?
No, not at all. The interesting thing too, in looking at the VIX there, the VIX has only exceeded or been to 50 like 3 times since its existence.
Yeah,
going back to the 80s. And even looking at it now, quite often when it's got as high as 50, and of course got as high as 90, back in 2008, 9, and the lowest it ever got was last year when it got to 8 and change. If you take a look at it right now, many times when it got to 50, it quickly pulled back. Mm-hmm. And that was it. I'm starting to see a little bit of, it's not moving down so quickly at this point. It's remaining elevated. And it's not going to surprise me if we see another burst higher on the VIX and stocks. Maybe we need like one more really big flush, at some point. Oh, good. You're going back and...
Yeah, I'm going to pull up because I know back in 2015, that was the last time we had a really big spike. So let's just take a look at the action in 2015, and then we'll get into some of your stocks.
Yeah, it's got a few today.
Oh, oops. All right, that's not going to work. Okay, let's take a look at 2015 on the VIX. And actually, let me put the S&P 500 on this chart too. So if you go down here and just put price in, and bring this up. And let's make it a little bigger. There we go. All right, so here's the VIX on top, and here's the spike that we saw where we went up to 50. And, I mean, it does remain elevated. Look at what happened to the market back then, by the way. We got the move down. We got a huge rally back. But we spent a good month back eventually and double testing or double bottom, putting in a double bottom on the S&P 500. And notice by the time we put in that double bottom, the VIX rose on this selling, but it had stabilized quite a bit from where it was prior. So, that might be something to take a look at. I think the more important part for me, and I remember this well back then because a lot of the relative charts didn't look very good. And when the S&P 500 took this drop and went down to 1,800 or almost 1,800, it was challenging some very significant price support from earlier lows that we had seen during this bull market. And so if that had broken down with relative ratios breaking down and a VIX up near 50, I mean, all of that would have been, I was on the verge. I was one of those people who had my finger on the sell button, ready to start shorting.
Yes.
Bear market. But it did hold. We put in the double bottom. We rebounded. And notice the VIX, just about 2 months later, went down below what I think is a key level, down around 16, 17. That's during bear markets. We've never seen the VIX. During the last 2 bear markets, we've not seen the VIX go below 16. So, bear markets require a lot of fear out there. But anyway, I mean, this could be a whole other long discussion.
Yes.
With that.
But the point is, the confidence that was in the market for many months leading up to year end, to me, that's gone.
Right.
So this is where and I want to have a couple stocks to show you because I want to show you the mode we're in now at earnings beats. Okay, we took advantage of that plunge last week. Let's pull up IBM. Okay, because I've been watching it. As a matter of fact, we had the stock out a couple of times to members with very like 2% stop losses, which happened. Then when it pulled back last week, I said, okay, this is really, really overdone. And so I put an alert out to members at 144.50 with a 155 price target, which you easily could get to if the market holds here. You know, and we're going to raise a stop, right? Because we already got a really nice move on this thing. I mean, I'm not thinking long term here. I'm thinking, you know, very short term. But it seemed like it got a little. They had great earnings.
Well, nothing. It doesn't matter right now what kind of earnings you had. Everything
doesn't seem like it.
The kitchen is being thrown. Baby's going out with the bathwater, as far as the market's concerned. Last week we saw, you know, except for maybe some of the financials, because again, 10-year Treasury yields were on the rise, so some of the financials were spared. But other than that, I mean, most stocks are just getting thrown out. They're all being lumped together and just being sold.
But this was, to me, looked like a high reward to risk, and it worked out. Here's another one that you talk about a quick trade: American Express, AXP. Okay, look at AXP. Look what it did. It pulled back, you know, just very, very sharply. And right when it got to about 88.50, I said, this is about enough on this one. And we put out an alert to the members right when it got to that 88.50 level with a target of 95. It got to 94.50 today. I issued a profit alert.
Sweet.
Because we got within, you know, less than 0.5%. It went up 7% in one trading day. And this is the kind of market where if I'm going to get 7 or 8% profit in a day or two, I'm taking it.
Yeah, this reminds me a little bit. Now the market conditions were totally different, but it reminds me a little bit. You remember back in 2007, October and November?
Oh, yes.
I mean, literally, the S&P was going down like 25%. I'll never forget this as long, you know, as I live. I remember, because I saw a lot of warning signs, and I got out of just about everything at the end of sometime in September, like third or fourth week of September 2007. And if you recall, from then until October 10th, we had this huge drop in the S&P 500. And I was thinking, wow, I'm glad I'm in cash. And I made the walk out to my mailbox one day, and I opened up the mailbox and I pulled out an envelope, and it was from T. Rowe Price. It was my kids' college education funds. And I wasn't trading those, so I hadn't even thought about the fact that I had their college funds. And literally, it was all, I mean, I'll never forget. It was October 10th. I walked out to the mailbox, I got it, and I looked, and that was about the time the market, I think, started to bounce a little bit. But at that point, I looked, and it was as of September 30th, and I knew how much the market had dropped from September to October 10th. So I just walked in, and I told the kids, I said, well, you know, you're going to community college. Well, recently, I mean, you're getting these huge drops, and then we get a big pop, and congratulate you on getting a couple of these at support. But you know I was getting stomped out, you know, hand over fist.
You know what's really interesting, Tom, is that I'll bet you, you know, we haven't calculated this year's return yet. Last year we had a killer year, right? We haven't calculated returns yet, and I'll bet you we've really slowed down on alerts for this year. So let's say we've had 10 alerts out. I'll bet you 6 of those, maybe 7 of them stopped out, okay? But we've had maybe 2 winners, and IBM looks okay now. And I will bet you that when we calculate the return, even though I could say 60 to 70% of the stocks we put out as alerts hit our stop loss, I'm going to bet you we're still positive or close to positive. And that gets to the risk adjusted, you know, where, and this is what you have to do in this market right now. And why I'm a little bit worried about, you know, you mentioned a couple stocks, VAR and PRGS, which are on my radar screen. I'm going to be, you know, careful about doing anything with them. I'd like to get them even a little bit cheaper, you know, as you laid out. We're going to have tight stops. If it stops out, it stops out. No questions asked. If we get any kind of a decent bump, we're going to take the profits. That's just the mode that we're in right now. You just have to be quicker than you take fewer shares. If you have to be involved in the market, instead of going all in, take 25% of what you have if you feel like you need to trade. And if you get a couple good scores, and that'll be terrific. But I personally am going to be extremely surprised if we don't see a retest or close to a retest of the recent lows. I don't know when it's going to be, but I think we're going to see it before we see the market skyrocket.
Yeah, I think that there's a couple levels, as the market bounces back. I think the falling 20-day moving average is going to be the first area to look at. I think even looking at your AXP that we just pulled up here, you got gap resistance and the 20-day moving average both up at around $96. So I think it's probably smart, when you get a stock that's up to 94.5 and it was just recently at 87.5, and 1 or 2 days later, you're back up close to that 20-day moving average. I agree. I think your reward to risk has completely changed now.
Exactly.
It's a good idea to get the heck out of it, take your profits, and let's see what the market's made of.
And just go, again, you remember back in the summer of last year when the market was going nowhere, there were sometimes we had no alerts on, maybe one, because it was consolidating. Consolidation can sometimes be wicked on your portfolio because nobody's winning. We waited till the fall. We got really involved with the market. We had 5, 6, 7, 8 alerts out at one time, right through the end of the year. And it was right at the end of the year, going into this year, we backed off to where we had maybe 1 or 2 active alerts going at once. Right now, we've got 2, and one just came off. American Express up 7% in 1 day. So we're gonna err on the side of caution, keep more cash than usual. I don't care if the market bumps a little bit here because I don't think it's going to be sustained. We'll just hold on to cash. Like I said, trade fewer positions than usual. Get through this, and maybe at some point we'll get through the rocky point and be in a better position. But I think it's time to really be a little more cautious than usual now.
Okay. Well, we got got to wrap it up.
Okay, great.
Did you have any other stocks, or is that it?
No, that's good enough. But by the way, the VAR is our chart of the week. You can find that at earningsbeats.com. Let me mention one last thing.
Okay.
I'm going to be doing a webinar next Monday.
Okay.
And I'll put it in my Chart Watchers article this weekend. And what I'm going to do is I'm going to talk about we added about 150 stocks to our chart list. These are companies that beat earnings. And I'm going to go over a bunch of them. It'll be so interesting to see where things stand a week from now. I'm not even going to predict.
I have no idea where it'll be. I'll let you know next Monday.
All right. Sounds good.
All right. There he goes. Appreciate it, John.
Yep.
Okay. Well, there you have a quick summary of the 3 symbols that John had gone over. Went over IBM and American Express and, of course, Varian. I do want to mention, as Aaron did earlier, I do have a position in Varian Medical. So I just wanted to make sure I disclosed that as well. And with that, I think it is time for the 10 in 10, Aaron. So what was that first symbol?
All right. The first symbol is 3M, but I'm going to steal the screen real quick and show everybody the RRG, etc.
Okay.
Let's go right on over there. And I put it right there. So these were the ones requested today that I was able to get in for everyone. And I'm going to just here's a quick candle glance just to show you how you can do this with your larger lists. And RRG is very interesting today. And as you can tell, I'm going to go down to what's leading, lagging, etc. We've got some strong ones here, and I always like to look at those stocks or in that industry where we're seeing things starting to lead, or improve. So anyway, you go take it away, and I will give you some of these, and we'll do them real quick.
All right. So the first one is 3M, and I just finished annotating that one so we can get through this one pretty quickly. I like 3M. I think this is another one that had very similar to what John was just talking about with IBM and AXP. They came out, they reported great results, but it didn't matter. Everybody was just selling everything last week, and so I think 3M on its sell-off went back into a very critical gap support zone. I like this candle, a little bit of a hammer, maybe kind of between a hammer and a doji. Very small candle body after it looked like it was breaking down intraday below the bottom of gap support, came rallying back. Very nice volume on that rally. But I put in this red arrow. I am going to be watching a lot of stocks. If I'm in stocks and they get back up close to these reaction highs and also close to that 20-day moving average, it's probably going to be a sell time for me. Move back to the sidelines, because I do agree I think Aaron, you had mentioned in the chat room earlier that you're looking for a double bottom, another bottom down the road, similar to what we've seen. I think John just mentioned the same thing. He's looking for things to roll over. I'm not quite sure. I mean, anytime you get the VIX up here, it's hard to kind of predict what the market's going to do. But I am looking for some sort of a consolidation, a continuation pattern, I should say, some sort of a continuation pattern, because I don't think this bull market's ended. Just my opinion. But the first step is going to be getting through these 20-day moving averages. So I just marked it there on 3M. So you can kind of keep that in mind.
All right. Next one I have for you is Priceline, PCLN.
All right. What I will say about Priceline, I'm going to do weekly on this one because I think it shows up a little bit better. I think we could still be in an inverse head and shoulder pattern here, which I find to be very bullish. Priceline had a rough week last week because of Expedia's earnings report. But Expedia doesn't tend to do well in the first half of the year, and Priceline does. So I would just say watch two things. Number one, I think we got a really nice neckline coming across here that eventually would be great if we see that broken. To the downside, I'm going to watch the recent lows because that is your inverse head. So I don't want to see that level taken out to the downside. But I do think that where it's currently positioned, I mean, if I'm playing this as a bullish pattern, a breakout above 1950 would measure up over 300 points to probably 2275 to 2300. So that is kind of my target based on this pattern. And downside, I'm looking at maybe 16 and a quarter. So reward to risk here on Priceline is pretty interesting. I don't own this one, but I do think that Priceline is very interesting based on the pullback.
All right. Next one is TPR.
All right, TPR. I'll pull the weekly up, and I'm probably going to go to the daily. Oh, nice breakout on the weekly.
Right.
Take a look at the daily here. We don't see a whole lot of these. I think this one actually, though, just reported. I think this increase in volume was because of a strong earnings report. I think TPR beat top line and bottom line, and given all the selling that's been taking place in the market, still managed to break out, come back and test its breakout level, and then move higher again today. So let's take a look at the level I'm talking about right there. We had pulled back prior to the earnings. Look at the volume come in. I'm almost positive this was earnings related. We break out, we go back down, we test the breakout level and that rising 20-day moving average, and then push higher. I would just keep a really close eye on that rising 20-day moving average. I think as strong as the stock's performing, I would expect it to continue to hold that moving average.
Okay. Next one we have is TDOC, and I know we do look at this one fairly regularly, but I thought it was interesting.
Teladoc. Well, we got multiple tops coming across here. I think it's pretty easy, I think, to visualize resistance coming across, and depending on whether you draw it, your lines using closes or intraday, I always tend to go with closes. So right at about 37.50 is what I'm watching. I'd like to see this break out above 37.50 with increasing volume. To the downside, I don't know, I'm kind of watching this gap support area where we've gone down and we've tested the top of gap support twice. So I think this is the trading range, and we're sitting almost in the middle of it. So I wouldn't have a position here. I don't really feel strongly about it one way or the other. But what I would look for is either a pullback down closer to 31 or a high volume breakout above 37.50.
Okay. See, number 5 is in the healthcare biotech area, HTBX, Heat Biologics.
All right, Heat Biologics. Well, it's not showing too much heat, that's for sure. This thing's frigid. Well, it just put in potentially a double bottom. So we'll see whether or not that continues to hold. Clearly, if it doesn't, I would be out. So I want to keep a fairly tight stop. I mean, this is a stock that it's a small dollar stock. So when I say a fairly tight, you have to understand it's probably 20 cents, which is 7%. Not exactly tight, but for this stock, it's tight because if you look at where the most recent high is, that would maybe be my target, which would be all the way back up close to 450. And from 290, that would be an interesting move to the upside because we got this downtrend in play. Possibly, we don't know this until it gets confirmed. Maybe this is a bottoming head and shoulder where we got the kind of the twin heads down here. But if we go back up, this could be a neckline near the 440, 450 area. So that's what I would look for. Overall, after the bounce it's already made this week, I'm not sure I'm real excited about it. but I do think it has a little bit more promise now that it has a double bottom in play.
All right. Let's go over to SeaWorld Entertainment, SEAS. Nice long-term, intermediate-term rally. Looking good.
All right. Yeah, continues to move higher. Notice it continues to bounce off that rising 20-day moving average. So for me, it's pretty easy. I mean, we pulled back, almost hit the 20 there, nearly had the 20 there. We closed one day below the 20 and then came right back up, which I think is good. Another test there of the 20. So there's no doubt for me, a big volume move back below the 20 would probably take me out of the position. But otherwise, I would continue to hold. Maybe one area, if you're looking at possibly a sell point to the upside, that shooting star candle was on some pretty heavy volume, and that's where the sellers kicked in up near 16. So as we get closer and closer to 16, that might be a level to watch.
All right. Twitter. Let's look at Twitter, TWTR.
Yeah, Twitter definitely has changed its character, I think, in recent days, recent weeks. It's been uptrending, but that was a really nice gap up after earnings. Now, it was a black candle, so maybe we hesitate for a bit. But I would have expected selling off of that black candle. We really haven't seen that. So maybe a little bit of a mixed picture, but I think it's all within a very bullish looking chart. So I'm a fan of Twitter. I don't think I would be a buyer here, especially given the market conditions. I think you've got price and gap support down near 27. I don't know if we're going to get down there. Got the recent lows after earnings at about 29.75. That's probably a more likely target for a possible short-term trade. And then to the upside, where we opened just above 34 is your resistance. So if I could get in around 30, I could keep a fairly tight stop with a target of 34. If it breaks down, I could get out, maybe jump back in if we fill the gap at 27.
All right. Let's do for our Canadian friends, an oil and gas producer, YGR.TO, Yangara Resources.
YGR.TO?
YGR.TO.
I like the hammer that printed on Friday. Very important price support level. So I definitely would hand it to the bulls on this one. Nice kick save right here. But there you can see the breakout. Here was a top, double top, broke out. Very nice volume, came down, held, and we just came down and just printed that hammer there. So, potentially this could be a topping head and shoulder pattern, left shoulder, neckline, head, neckline, and then, maybe this next move is the right shoulder. I'm not looking for bearish outcomes because I'm not bearish at this point in the market in general. I'm just pointing it out that it's something to watch. If we do go back down and fail to hold $4 on the close, that would be my stop because of a possible topping pattern. But other than that, I would be okay holding this one.
All right. The next one, Weyerhaeuser, WY.
Yeah, on the paper side of things. Really surprised that it failed to hold the recent lows. And the volume has not been light on this selling. So the lows that I was looking at are right in here. See multiple tests down at about $34.75 to $35 over the course of a couple of months. Moved up, broke out above these prior tops, and we did so with pretty nice volume. But like I said, the selling came in. It didn't matter. It doesn't matter about technicals. Doesn't matter about earnings. Doesn't matter about much. We just have been selling off heavy volume. Probably would have to look at a weekly chart to try to find something. I mean, clearly the last low here could be a support level on the daily chart. We almost got there on Friday, but maybe the weekly chart might look a little bit better. But I'm a little suspicious moving to 4-month lows here on Weyerhaeuser.
Okay. And the very last one is FAX, FAX, which is Asia Pacific Income Fund. Sitting on interesting support, but the PMO doesn't look good, and I just got a 20-50-day negative crossover. So,
yeah, and I mean, to be honest, this isn't really my style. This isn't something that I would buy. I tend to be much more aggressive, and if I can't find something aggressive to buy on the long side, then I'm probably either going to be looking for shorts or I'm going to be in cash. But you can see technically we did hit a pretty significant low back in mid-November, just at about the 4.725 area. So that's a level to watch the downside. Recent high is up at 5. So you can see that it's a very narrow range. I'm a short-term trader trying to take advantage of some pretty sizable swings, and this one is not one that's going to move very fast for sure. So I just don't see a trade here for me, but I would watch support 4.725 and resistance up closer to 5. I think that's your trading range for now.
All right. Yeah, I've held that one before as sort of a long-term, conservative type of investment. It was paying some pretty good dividends a while back. But anyway, 10 and 10, here is what we covered for you today. Those are the symbols. I'll have those up after the show, and you'll find all those annotations that Tom made right there in the Market Watchers Live chart list. And you can find that by going to the Market Watchers Live blog. And the link to that chart list is right there at the top of that blog. With that, I'm going to move over to our final market update. And here we go. All right, here's our candle glance, and I'm going to refresh it just to make sure we have everything in it. And there we go. So certainly a bit of a better day we're looking at. Friday wasn't so horrible, but we're seeing this nice rise. We've been pretty much in the positive all day, and the S&P did pull back to yesterday or Friday's close and is starting to head back up and is starting to flirt with some more intraday highs. NASDAQ also rebounding off of yesterday's close and continuing higher. Russell 2000 started off the day negative, does seem to be pausing and consolidating right up next to its intraday highs. TSX is forming I would say, a bullish ascending triangle here. Right now, flirting with that overhead resistance of that triangle. We could see a breakout here and higher prices. And Treasury yields are up, kind of a volatile day, pulling back and coming back out, currently reading at 28.62. UUP is down right now, and it looks like it just recently posted an intraday low, but coming off of that, we have commodities, gap up, and then consolidation, which of course mimics USO. Oil with the gap up and sideways consolidation at this point, reading just under $12 at $11.97. GLD has been making a nice move upward after a gap up, but it does seem to be rounding off as far as the top. We'll have to see if it can get above those intraday highs posted earlier in the hour. And the VIX is lower, but we are still seeing a reading of 26.89 on the VIX, which is still elevated at this point in time. And we can see that advances are leading the declines from Friday. And let's go to our member homepage and see our market summary here. There we go. And currently, as far as sector spiders, energy and materials having the best day, up over 1.75%. Utilities back on the bottom of the list, but is still utilities are up almost 0.5% right now on XLU. Gold and oil services, transports are leading as far as the industry indexes. And we can see laggards, the only three in the negative of our industries on our list here are retailers, REITs, and paper, which is the laggard, down 0.67% currently. International ETFs, India, Russia, Malaysia, all heading the top of the list. And we can see Singapore is the laggard, but it is still up over 0.25%. So overall, we're looking at some bullish action in the markets across the board and globally at this point. And with that, I'm going to complete our market update. Did you have any news you wanted to comment on while I get ready for my DecisionPoint report, Tom?
Yeah, I'll just look at one chart real quick while you get set up. I wanted to point out, because energy is leading today, but energy, if you look back over the last week and the last month, has been the worst performing sector. And this chart, this is the XLE relative to the S&P 500. You can see how quickly, after a double top breakout, energy literally, 3 to 4 weeks ago, looked like one of the better areas of the market, and it has completely fallen apart. And I just want to make you aware that the XLE, if you go back and you look at the components that make up the energy ETF, you're talking about ExxonMobil. So let's look at these charts. ExxonMobil has been absolutely getting crushed. Even today, even with it being up slightly today, it's got another filled candle. It's got if you zero in right here, you can see that each one of these candles on the way down are filled, meaning that we're below the open. And the ones that are complete have already closed below the open. And today, right now, we're currently trading below the open. So it seems like ExxonMobil, which is the largest holding of the XLE, cannot get going. And then if you look at CVX, which is another one, Chevron, again, if you come over here and kind of zoom in, you can see that there's only been one really good, solid, hollow candle kind of a day on Chevron over the past two weeks or so. So there seems to be a lot of distribution taking place in the two biggest components. And we could throw the third component in there, Schlumberger, SLB, and you're going to see not a whole lot different here. Outside of maybe the gap up today and one day last week, I think it was Tuesday, where we saw a little bit of strength. Again, zeroing in, will show you that we've got a lot of these filled candles where there's a ton of distribution taking place. These three stocks that I just showed you are 50% of the XLE, or pretty close to 50%. And that's why over the past couple of weeks, or last week, or even go back last month, why this group has been underperforming so much. So I just wanted to point those three stocks out. If you're wondering, if you got the XLE and you're wondering what's going on, these are the three companies that are really driving that XLE lower, although we are getting a bounce today.
All righty, I'm going to grab that screen, and it's time for the DecisionPoint report. I'm going to go over major markets, and we'll look at the indicators, ultra short, short term, and intermediate term, and a UUP, gold, oil, and bonds. I'm going to cover all of those in the next 10 to 15 minutes. So let's get started. If you're interested in seeing these charts, they are in my DecisionPoint blog chart list. So you just go over here and find DecisionPoint. There we go. Let's make this so we can see it all. And there's the live chart list, and all of those charts that I just showed you are in here, and they are annotated for your review. So anyway, let's get back over here, though. I want to show you what we've got going right now. And currently, when I look at the indicators, I'm going to go first to the SPY chart. Let's look at what's going on with the SPY. And I look at the SPY because that is where I give my market timing signals. We use the SPY to turn those in. And you can see the 20 is starting to get very close to a negative crossover with the 50-day EMA. As Carl pointed out, though, you know, when you're in such a strong rally, such as we've seen, you start to get a lot of margin between the EMAs. And, you know, our long-term sell signal is when the 50 crosses below the 200. Well, clearly, that is going to take a very long time to come about. So I know that as far as calling a bear market at this point, you know, typically that's what we would look for. But at this point, I don't think that signal would be all that helpful, because by the time you get that negative crossover, I would think the bear market, if you were in one, was about ready to turn around. So, but I think what you really should note here, first of all, we were in a parabolic rally. And when you have parabolics, they generally resolve to the downside very quickly. And that's exactly what happened. And generally you look for them to break down and come down to, you know, an area where we saw some consolidation. And that's what we're at now, in my opinion. You know, we had this area mostly flat trading back in October, November timeframe. And we've reached that, and we've reached the 200-day EMA, and we've bounced off of it. I think all of that is very positive. And notice my PMO is now finally starting to unwind to appropriately for the decline. It's still in positive territory, but just barely. And remember that the normal range for the PMO on the SPY, and most of the major indexes for that matter, is between 2 and -2. So we're sitting right at the zero line. There's certainly more you know, downside that could be accommodated, let's put it that way. But if we are going to continue in a bull market situation, this is where we want to start seeing that PMO turn around. That would tell me that despite this very difficult decline, that there was some possibility for a turnaround, and that there would still be some internal strength left over from this very strong parabolic rally. So I'm looking for this bounce to continue on up. And after that, as I've been telling people in the chat room, I would expect another retest And if we get below that previous low, that's when I would start to really start to get nervous. But at this point, if we can hold on to that low, hold on to that 200-day EMA, even with a pullback, I think we're going to be all right. But I think Carl made a pretty good case for the possibility of a bear market possibly starting. And I know he looked at the weekly chart as one of the things, because, I was just talking about that area in October, November as a nice area of possible support where we saw some consolidation. But, when you look at the weekly chart altogether with this, there are so many levels for it to move down. And as far as a parabolic formation goes, I mean, you could certainly make a case for price to go all the way down to the 2200 level to about the beginning, where we started this really huge bull market rally. Look at the PMO on the weekly chart as well for the S&P 500. We now have a negative crossover. And if that holds, we will see that change on the DecisionPoint scoreboard, which is right here. And I will show you how it will change. So if that negative crossover on the weekly chart holds for the PMO, we will see this signal turn to a sell signal. And that should give us all some pause. I'm not of the, I think it's early, and I know, Carl's looking at a possible bear market here. I think what I'm going to probably end up talking to you about on Friday's workshop are bull and bear market rules. I don't think we necessarily are in getting ready to hit a big bear market, but we're certainly in a position, I would say, when you look at when you look at the charts, I mean, I think you can make a case for, a decline that's going to fall fairly low. And when you get that negative crossover, I don't like it. I definitely don't like it. But I don't think we're necessarily in for a move all the way down to this, 2,300, 2,200 level. I think we're going to find some rebound here. But while we're in this type of a decline, I think it is important to understand bear market rules. And so, like I said, I think I'll go over that on Friday, bull and bear market rules, and how you need to look for which ones to use and what they are. So I'll talk to you about that. But I would say we are in a position, and I agree with Carl, where we might want to be thinking bear market rules, meaning our expectations shouldn't just automatically be bullish from various signals or, in this case, a PMO sell signal. So normally, when we were in this big parabolic rally, I'd see that and I would probably not worry quite as much. But, we've had this big move. There's that possibility out there that this could become more. So let us go ahead, and I'm going to look at our indicators right now. These are the climactic indicators. This is, where you do your candlestick evaluation. You're looking for what's going to happen over the next day or two. I'm not looking for, this can kickstart something bigger, but that's, these indicators are just to give me an idea of what to expect, going into the next few days. And we did see some elevated readings on Friday for breadth. And we didn't have a corresponding, we did have a penetration of that bottom Bollinger Band. So looking at it, I would look at this as more of an initiation. And I say that because we were in a pretty solid downtrend here when we got these climactic readings. And whenever I see climactic readings, I'm always looking, is it an initiation or is this an exhaustion? And since we had this down move, I would have looked, and I did look at these negative readings as an exhaustion of selling. And now we're looking at these positive readings coming through on Friday. And I would look at that as an initiation. We're just now starting to see that move up. So I think when you look at the short-term indicators, it also makes a case for this being a short-term bottom. And I say that because you can see our short-term indicators are highly oversold. I mean, Carl did mention, we can see readings down to the minus 600 level. True. But when I look at what's happened over the last 2 years, we have not seen anything quite that deep as far as oversold readings. And so looking at that, I think in the short term, this is telling me to expect some upside. I think the climactic indicators are telling me to expect some upside. However, when I look in the intermediate term, not quite as positive. We still have these indicators, our intermediate term indicators, falling very quickly and with no deceleration just yet. This is where we really wanted to see these guys turn up, because if you get them oscillating pretty much above the zero line, well, that tells you have a nice, strong bull market, some lots of internal strength going on there. And now we're starting to see some low readings that we haven't seen in quite some time. Want to start seeing those turn around. This is sort of similar as to where we have been previously. So we're going to be really looking for that bottom on these indicators. And when we get that, that's when I would, start, not worrying so much about an upcoming bear market possibility. But right now, I think that these, as well as the intermediate term PMO sell signal that's in the making, really can tell me that we're not really out of the woods as far as whether this is a bear market or not. So I'm not going to go in there, Tom, like you with nope, it's not. I'm still a little bit sensitive right now to those intermediate term indicators and that IT PMO sell signal, which we haven't seen in quite a while. All right, so let's look at the dollar. I was watching that head and shoulders. It did execute. We hit the minimum downside target almost exactly. Very interesting when you see textbook conclusions to formations, and we've gotten the bounce, but we are starting to struggle here with that overhead resistance. I think we're going to end up seeing it move through because we do have a PMO buy signal in place. Look at the OBV. We had this really nice accumulation going on here. I like it, but this concerns me, that 2360 level. I'd like to see it get past that. And when you look at a weekly chart, you can see really how important that is. We really need to get it back above. At that point, I would start looking for a $24. But we're just not quite there. I think that given the buy signal on the daily chart, and you can see right now the PMO, though on a sell signal on the weekly chart, is starting to decelerate. So I think we have a good opportunity here to get back up to that $24 level. But I'm not looking too far past that at this point. Gold. I continue to be bearish on gold. We hit that overhead resistance, and since then I've been looking for a pullback to 1300. We've come very close to that. Given the PMO and its inability to unwind quickly with this decline, there's still so much more room for it to fall. I think we're not out of the woods yet for gold. I think we'll be lucky if it holds 1300. That's kind of the area I'd be watching to see if it can hold. I do think, and as I said, when we hit that top, we will test 1300. I really don't have too much doubt in that. After that, I'd start looking at this 1260, 1240 level, depending on how the PMO has unwound at that point. So let's see, two more real quick. We will look at USO oil. I know there's a lot of discussion about oil. We've hit a very important area of support right around that 1160 range, somewhere in there. And we're bouncing back up, but the $12 level is already causing some issue. And you've got a PMO that's still in decline. It's near-term oversold, but it's not even decelerating. And look at the OBV. That's a lot of selling. The good news is the scooter is still remaining fairly high. So there's still some internal strength in there. This might have been all we needed as far as unwinding oil. And this is a great spot for it to start moving up. But I can't get bullish on oil until I start seeing at least some deceleration on the PMO. So I'm going to remain bearish on USO. And I think looking at the weekly very quickly, you can see, well, it's kind of a messy weekly chart, but this is an area of really strong support right at about that 55 level. So we are getting close, but I think we might need a little more downside. And TLT, to close it out with bonds, double top execution when it fell down below this neckline. Got the new long-term trend model sell signal going on after a neutral signal back here for the intermediate term. The PMO is still ugly as it can be. Look at volume is pouring out. This is a great place for it to find some support. I'm not going to lie. I think that's a pretty great place for support, but I don't think we're there yet. The minimum downside target for this particular formation would bring us down to the 114 level at least. So I'm still looking for a test at $114 on TLT. And that's all I have for the DecisionPoint report. So took us right up here until the end of the program.
Awesome.
Let's go ahead and look at the summary for you. So what you can see right now is, the stock market outlook. I'm looking at the climactic indicators as a bullish initiation. I think the short-term indicators are bullish, but I'm still having issues with the IT. So that's why I'm calling for a double bottom here. I'm looking for the rally, a retest of last week's lows. And then as far as the big four, dollar, I'm bullish, but there is that strong overhead resistance at 2360, which is bothersome. Gold, I'm still bearish. I'm still looking for a 1240, 1260 downside target. Oil, I'm neutral to bearish because we have some pretty strong support there at 1157. Bonds, I'm bearish, looking for a $114 support level for TLT.
Very good.
Mm-hmm.
Yeah, you made some really good arguments. I mean, I think when you're talking about a bear market, obviously the first thing that has to happen is you have to start seeing price weakness. You can't have a bear market if the market keeps going higher.
Mm-hmm.
You got to turn lower. So, anytime we see something move down, and every bear market is not the same. They don't all get started the same way. If they did, it'd be really easy to spot. So, when you are pulling back, I think for me anyway, I'm going to be paying very close attention during rebounds. Maybe this is one that'll last a little bit longer that we're in right now. Maybe it won't. Maybe, by the end of the afternoon, we'll be in red territory again. But when we get an extended move to the upside, I'll be watching, number one, to see if the volatility index is settling down. Number two, I'll be looking to see where the money is going during that rally. Are traders still interested in trading these aggressive companies? Is that where the money's rotating to? Or is it more of a defensive kind of a move to the upside? So those are some of the things to look at. There was a question that came in. There were a few questions, and I jotted them down. We can't get through all of them right now. But one was, what news could send us into a bear market? And I would say, first of all, it's nobody announces that there's going to be a bear market. It would be really easy if somebody would just go on CNBC and say this is a bear market starting. Everybody could just get out. But it's
honestly,
really,
that would tell me to get in.
Yeah, probably. Well, actually, we do have a lot of people who try to do that. It doesn't work out very well. Been doing it. They've called 9 of the last 0 bear markets. But I think that number one, you have to keep in mind that the stock market is a leading indicator. So the stock market is looking ahead, and it begins to price things in before we actually begin to realize it. I mean, if you look at the earnings that just came out in January, I mean, the earnings were stellar. And a lot of that was being priced in with the huge move that we saw in the fourth quarter of 2017 and into the January of 2018. So the market has a way of pricing things in. So for me, it's about watching the price action, everything taking place beneath the surface, and not trying to figure out why things are happening. I think that's probably one of the biggest keys when you look at technical analysis is, as technical analysts, we don't care why. We just want to know, what's happening. Where is that money going? The why questions are for the fundamentalists. Folks who look at things on a fundamental basis always have to have a reason. And it drives me crazy right now because the market going down the last 2 weeks, everyone's blaming it on higher interest rates. Yet I could bring up 100 charts that show you that when interest rates are rising, stock market rises with it. Now, it didn't work this last couple of weeks, and it doesn't always work. But that is when you look at history, that is the way the market works. Money comes out of the bond market, sending yields higher. And that money finds its way in the stock market, sending stock market higher. So I think it's a waste of time, really, to try and sit back and figure out why. I think it's a matter of looking at the charts and what's taking place in the market and drawing your own conclusions from that.
Mm-hmm.
But we are running out of time. What do you think this week? Before we get into the announcements and so forth for the rest of the week, what do you?
Sure.
What do you think?
As you just saw, with my indicators, the ultra short and the short term, really, I'm looking for a rally coming into this week. I think we're going to rally off of this bottom. And once I see how it's reacting to that rally, as far as my indicators go, will the intermediate term indicators turn up? That's when I'm going to start really looking seriously as to whether we're in for, a bear market. What are those indicators saying to me? Are they pointing to some weakness within the rally or not? And we'll talk about that this week. I'll keep you all posted, of course.
Yeah, I would say, I'm looking for the same thing. I'm looking for a bounce, but I think the declining 20-day moving average is going to be the first really big test. If we get back up and test those areas, do we go through? I think if we go through, it's probably pointing more and more to consolidation before we end up breaking out again later in the year. If we can't go through and we end up breaking those recent lows, then obviously that would kind of change things in the near term. So we'll have to kind of look at it. But here's your weekly schedule going forward. If you want to go through.
Sure.
That.
So tomorrow, everything stock charts. Not sure who's coming in yet from the Seattle area to talk about it, but we'll find out. Charles Kirkpatrick, author of Technical Analysis, the complete resource for financial market technicians, will be in on Wednesday to talk with us. And Julius de Kempenaar, the RRG creator, will be here Thursday, and we'll talk RRG. Friday, I will be doing a workshop. I think I'm going to do it on bull bear market rules. And that's all we got.
Yeah, it's going to be awesome having our guests in, Charles and then Julius later in the week. Always fun to have our guests on here. And we have such a wide variety. I always like to find out what makes everyone tick and what they're looking at. So it'll be a great week of guests for sure. I do want to thank everybody for being with us today. Crazy market out there. Please remember to complete the survey as you exit. We do love to get your feedback. We respond. We look at all of them. We can't respond because a lot of times we don't have any emails to respond to. But we do review these, and we do try to make them part of our shows going forward. So just know we do appreciate your comments. As a reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Monday afternoon, everybody. We'll see you back here on Tuesday. Happy trading.